what I'm going to do is give you a general idea of what we're going to be talking about for the next 3 hours. You already know it's about retirement accounts, but it's really not about retirement accounts. It's about something much, much bigger, much, much more important. And it's the cornerstone, or should be the cornerstone, of every one of our listeners. And it is not. I know it's not. I'm going to prove to you that it's not, but it should be. One of the things that Leah and I have done from day one, which was about 1.5 years ago, is we wanted to teach people principles of investing, not just in the crypto space and in Bitcoins, but principles of investing that I have learned from others over a long period of time, and then some techniques in which to accomplish those principles. And the techniques are technical tools and fundamental tools, but they really have nothing to do with the fundamental principles of why you invest and how you invest and what pitfalls you're going to run into and how to try to avoid those pitfalls. So that's what lucid investment strategies means. It means lucid, or clear, simple, concise, battle-tested principles that never vary over time. We all get away from them. We'll learn 1 or 2 things, and then we'll try them out for a while and get bored with them and go on to something else. But the principles don't change, never have changed. And I'm not just talking about the last 40 or 50 or 60 years. I mean, for the last 1,000, 2,000, 5,000, 10,000 years. And we're going to talk about one of the most basic of all those principles today. Not retirement accounts, because retirement accounts have just come along in a very short number of years past. But retirement accounts are based on a thing called compounding principal and compounding interest, or the compounding effect of doing the same thing over and over again, so that you approach what could be exponential growth. And it's very difficult to do that for a lot of reasons, but we're going to go into all those reasons. We're going to talk about what retirement accounts really are, how you should look at them, and why, if you are not fully funding every possible account that is a tax-deferred retirement account, you need to. Before you do anything else, before you use Consensio or Celgene or Hyperwave or relative strength indexes or price to earnings ratios, or think about long-term trends versus intermediate-term trends and short-term trends. All of those things are tools that you should have in your toolbox. But the question is, what are you using those tools for? What are you trying to accomplish? It is true, it's like a video game to a certain extent. You know, it's fun to watch these things moving around, and if you put some money in here and it goes up here, you can jump back out. But that all loses a much bigger perspective. And that's what we want to talk about today, is the single most important thing you can do to build your wealth, your family's wealth, to take your hard-earned dollars from work, your hard-earned experience and education from going to college, getting an advanced degree, or not going to college, but learning on the job things that stay with you. All of that is your experience as a person. And each one of us is different, but we all have commonality. We all need to do basic, simple things. once other people aren't doing them for us, meaning parents or teachers or your boss. As you go through this experience, there are certain things that are real assets and other things that a lot of people think are assets, but they are not. They're very temporal. They come and they go. The real assets you have are the morals and ethics that you learn growing up. Your education, even though it seems as if all that nonsense you learn about numbers and languages and history and sociology and politics and economic, when you're going through that, it's meaningless. What you don't realize is some of it sticks. And you recall some things that move you in a certain way. And each of us are attracted to different things. But the reason I'm telling you that is that early experience of learning right from wrong, learning about the way the world is through education, what it was before, what it is now, and what it might look like in the future. That's all part of education, which tells you how you're going to interact with other people, other jobs, start a family, with your family, what you're going to do, how you're going to do it. None of that has anything to do with assets the way people think of it. But they're the most important assets you've ever gotten or ever will have. Beyond that, you decide at some point after you've reached a level of education that you've had enough of that nonsense. Now you want to put it to work. So you experiment around with different types of jobs. You try this one, doesn't pay enough, and you're not very happy. You try this one, you don't like the boss, and you don't like the location, and you don't like the commute to get to it. And so you try another one. Finally, you find something that feels right and hopefully is an extension of what you've learned in previous years through your education and your experience with other people, and it all starts to click. But now what you have to do is you have to turn all of those assets you have to add a new one to it, which is time. And you've only got so many hours in a day. And you've got to sleep some of that time, you've got to eat some of that time, the rest of it you've got to work. And when you're working, there's people looking at you to say, are you working hard enough? Are you working long enough? Are you being effective enough? And to the extent that you can answer those questions yes, and they can answer those questions yes, what ends up happening is that you give your time and experience to that party to get what most people think of as assets in the form of payment in fiat currency or in other things that you then do stuff with. But remember where that came from. It came from all the stuff before being translated into something that you have chosen or you have fallen into. And by doing that, you've eliminated all the other things you could be doing. Don't ever forget that when you make a choice in terms of what you're doing and how you're spending your time, by definition, it means you are not doing anything else. And therefore, you're giving up huge opportunities to get that reward. The same as in the investing world, the opportunity risk versus the real risk of losing assets. Okay, you didn't expect to hear all that sort of stuff, but it's very important when we're talking about this subject today, which is retirement accounts. It's very rare for someone other than a close friend or a family member to give you something and don't expect anything in return. And it's not fair to think that an employer or business partners or associates are going to give you something without something in return. Sometimes it happens, but you can't count on it. It's very rare, and it's great when it does happen. So let's just talk about your relationship to your employer. If you are self-employed, you still have an employer, and that's the other people, the structure that you're in, an LLC or a subchapter S or a real corporation that might be small, middle, or large. If you own those things, you are still being employed by that structure. And we think when we run our own companies, I've been running this thing called Lucid Investment Strategies. I gave up running that about a week ago, and now my son is running it. But he is being compensated by the structure. You are being compensated by the hospital that you work for, or the fire department you work for, or the band that you play in, or the school that you teach in. None of that matters when thinking through these ideas. It doesn't matter who you are or what you do, we all do the same thing, and we all follow the same pattern I've just described. And that's been true for 10,000 years, and will be true for another 10,000 years. So what we're going to talk about today is one of the few times that you have been offered by a third party something for free, and they don't expect anything back. And that's what a retirement account is. And people still don't get it. They still don't understand that simple principle. So we're going to talk about that, and I'm going to show you why I say that. And then we're going to get into a lot of detail. And the detail we're going to get into is going to be, first of all, focused on the United States. For many, many reasons, most of our listeners are in the United States, but beyond that, because this is the largest economy in the world, and we have the largest financial markets in the world, we have the largest pension funds in the world, we have the most choices in the world in general. But then we're going to also talk about the rest of the world's situation relative to retirement accounts and pension funds and super attenuated accounts down in Australia and a bunch of other things, not for the idea of trying to get into details of what you can do compared to what I can do, but to show you and prove to you that we're all doing the same thing with slight variations. And much of what is happening around the world has come to us because of what the United States did about 40 years ago. And so this is the long introduction into my presentation today, which will go on for 3 hours. It'll be basically broken up into 3 distinct parts, and you will see those develop as we go on. You don't have to take notes. You can wait till Leah sends this video out to you, and then you can speed it up if you want to. I know a lot of people that listen to me like to listen at 2x or 3x speed, but I am not going to go any faster than I normally do. There's a lot of very important points that I want to make, and we will do that by way of, let me see if I can do screen share here. I think I can. Let's see, this looks about right. Let's try that one. Let's blow this up. And I think you're looking at something that says Retirement Accounts Lucid Investment Strategies. Leah, can you acknowledge that we're all seeing that? Okay. Let me do this. Oh, how do I make that big? From beginning. Okay, good. And there we go. Excellent. Now, I'm still not sure if everybody is seeing this. If someone can let me know. I will assume that everybody is seeing this. And I'm assuming that everyone can hear me. I'm getting a message. All good. Beautiful. Okay, great. So this is called Retirement Accounts, presented to you by Lucid Investment Strategies. We want to thank each of you for ponying up money to listen to this. We try to give as much as we can away for free through our blogs. As you know, we're doing more and more of that almost every single day now, because I've got great assistant, great partners with Leah and with Socrates, and now my son, that will help us accelerate the amount of information that we can get to you. But these kind of webinars take an awful long time to put together, many hours. And even though they go on for 3 hours, I think you will find this one particularly interesting, and the one we're going to do in another 2 weeks, probably the most interesting we've done because of what's going on in the markets, which will be on consensio, intermediate and advanced use of that particular tool. Okay, so let's take a look at a couple of dry numbers, starting with a thing called the defined benefit pension plan. This is where it all starts. And what I mean by that is that for many years, when you went to work for a corporation, and usually only a pretty big one, did they promise that if you stayed with them and retired with them, they would pay you after you stopped working for a period of time. And usually it was for the rest of your life. Sometimes it wasn't, but usually it was. That's called a defined benefit pension. It means that when you retire, you would be given this pension fund, and it would keep paying you as long as you were alive. And very often, it would pay your spouse after you died. That was the case with my father, who worked for the American Bar Association, which in the United States is the association of all the lawyers and judges and the legal people. And they had a defined pension plan. So when my father died a number of years ago, my mother continued to receive that pension plan. Now, when you had a defined pension plan, you didn't have to do anything except go to work. But take a look at these two statistics. 60% of non-government workers had a defined benefit pension plan in 1980. That wasn't that long ago. I had been in and out of the military before that. I had started my career in finance before that. So to me, this is not very long ago. 60% of all non-government workers had one of these things. Today, only 4% have them. What happened? Why did it happen? Now, this theme is going to run through no matter where you are in the world. The dates will be a little different. The percentages will be a little bit different. but this same basic structure changed over this last period of time, this last 30 to 40 years. Today, the total value of pension funds in the world is about $20 trillion. Now, there's about 7.5 billion people in the world. Not all of them are working, but if you say that 1 out of 2 approximately are working, and divide that by 20 trillion, it means that the average person has got $5,000 in a pension fund worldwide. Obviously, that number is not very significant because the variation is huge between those that have nothing and those that have millions and millions and millions of dollars in pension funds and retirement accounts. But it just gives you some idea. Just think for a second. You've been working for 40 years or 50 years. You're ready to retire. If you're average, you got $5,000 for the rest of your life. That's a problem. Here are the number of funds, large funds, the 300 largest pension funds in the world, which make up approximately 90 some odd % of all the pension funds. There's not that many. And you see, I just picked out some things. We're going to look at some of these countries in just a minute, but in the United States, there's 133 of the 300 largest funds in the world. One of the reasons I'm using US as kind of the base of this discussion is it just so far outstrips everybody else, and almost everybody else is trying to duplicate to a certain extent, other than the politics involved having to do with capitalism and socialism, where things happen and how people are paid on retirement. But putting all that aside, just take a quick look. This makes up a very large portion of what we just talked about, which is $20 trillion, fall into these 300 largest funds, a huge percentage of which are in the United States, 25 of which are in the UK, 18 in Canada, etc., 7 down in Sweden, Denmark with 8. Okay. We're talking about pension funds now. That's a little bit different than talking about the wide world of retirement accounts, but it's an important part of it. And it's important for you to understand how all this works. Here are the 10 largest pension funds in the world. A fund that's called the Government Pension Investment of Japan has got $1.4 trillion in it. Remember, there's a $20 trillion total. So out of that $20 trillion, 1.4 of it is just sitting in that one fund, which is over in Japan. They started this early. It's grown to be the largest in the world. Norway is number 2 with 1.06. These are of the 10 largest of those 300 we looked at. South Korea has got $500 billion. The US has got the Federal Retirement Thrift, which is for employees, military, that sort of thing. That's got $500 billion in it. $500 billion in the National Civil Pension Fund. China, National Social Security. China, California Public. One state has one of the 10 largest pension funds in the world. That's California. Public employees, $1/3 trillion. Canada, etc. So you can see how it's spread out. The US isn't number 1. It's in fact down at number 4. One of our funds in the US, we've got 133 of them. One of them is very, very large relative to the rest in the world. Now we're going to get a little bit esoteric but this is very important, having to do with what I talked about before in my introduction. I'm going to look at some numbers, and we did this in our vlog back in April of 2018 that was on retirement accounts. I use these same numbers. Many of you have not heard that or listened to it. We're going to go into much more detail today. And these numbers are 33, 35, 11, 5, and 15, and you'll see why in just a second. And this has to do with participation in the United States in retirement accounts. Then we're going to look at four other numbers, 32, 14, 79, and 14, which to me are very remarkable, not until they're explained, but once they're explained, you'll see why. So let's get right on with that first number, 34. You heard us talking about this at various times, but I'm going to try to let it sink in to those of you who are going to listen today and those that will be hopefully buying this webinar in the future to be able to get the overall sense of where this is going. 34% of all the adults in the United States have 0% in savings. 34% of all the adults in the United States have 0% in savings, as defined by retirement accounts, savings accounts, things like savings in bonds, savings at a savings and loan, savings at a bank, and or investment accounts at Fidelity, Schwab, E-Trade. That's my definition of savings. 34%. We've just been joined by Socrates. Thank you very much. Socrates, can you hear me okay? Maybe so, but maybe his mic's not turned on, or maybe Leah has muted him. But in any case, welcome. He will be joining, and anytime you want to jump in on any of these points, that will be great. Okay, that should be shocking to everybody. Unfortunately, it's not shocking enough because a lot of us just assume that we've got big problems in this area. But to me, this is staggering. Now, when we talk about 34%, we mean anyone from 18 all the way up to 120. So this is the entire spectrum of adults in the United States. That means people that are retired and are employed. It means people that are in their 20s, their 30s, their 40s, their 50s, all the way up to those fortunate enough to be over 100. My mom lived to be 94 years old. One of my clients' father just passed away. I believe he was 102. There's a huge long spectrum that keeps getting longer, but just hear what this is saying. 34% of all those people, all your friends and family in the US have 0% in savings. Number two, an additional 35%. Hey, Socrates, can you hear me okay?
I can. How's it going?
Great. We just got started. We're going through a bunch of numbers. I think you'll find them all fascinating.
I love me some numbers.
Yeah. The second number is 35, and this says that 35%, in addition to the 34% we just talked about, 34% of all adults in the United States have 0 in savings as defined by retirement accounts, savings bonds, investment accounts. That's what we mean by savings, where you have moved money from your income stream into this thing called savings, It doesn't mean you're investing it in an investment account. It can be sitting at Fidelity or E-Trade or Robinhood or something in the form of cash. That's what we're talking about savings. 34% of all adults have zero. An additional 35% of all adults age 18 to 120 in the United States have less than $1,000 in savings. Now we are up to 69%, or almost 7 out of every 10 people, adults 18 years or older in the United States, have less than $1,000 in savings. The next number is 11. This again is in addition to the 69% we've already covered. The next 11% of all adults in the United States have somewhere between $1,000 and $5,000 in savings, where savings is defined as checking accounts, savings bonds, retirement accounts, and brokerage accounts, investment accounts. That brings our total up to 80%. There's 350 million people in the United States. 80% of the adults aged 18 to 120 have from $0 to $5,000 in savings. And the final number of the sequence is 5%. No, this is the second to the last number. The last number is 15%. This again is in addition to the 80% we've already looked at. 5% of all adults have between $5,000 and $10,000 in savings, which means that 85%, 85 out of every 100 people you pass in the airport, pass on the road driving, live in your apartment complex, live in your suburb, live in your city, 85 out of 100 of them have less than 10%, less than $10,000 in savings. Now, as that train of time moves from 20 years old to 30 years old to 40 to 50 to 60, where you've got energy and aspiration and you're working and you're working and you're working, you're getting closer and closer to retirement. At that point, all of those people that are hitting that 65, 70 area fall into all of these numbers. They are not excluded from these numbers, which means an enormous amount of people that are on their way through their 30s, 40s, 50s, and 60s are included in this 85%, even though they've been working for 10, 20, 30 years, which gives us the final number of 15, which is that 15% of all adults in the US have $10,000 or more in savings. Now, that includes Warren Buffett. He's part of that 15%. It includes all the billionaire hedge fund managers, all the CEOs of corporations, all the executives in all the corporations in the United States. It includes all the people who have inherited huge amounts of money from parents or grandparents or great-grandparents and live in huge mansions. They're all in that number. So the ones that aren't in that number or are in that number but don't include what we think of as the super rich, the upper 1%, is everybody else other than the 85% that we already know only have $10,000 or less, or even more frightening, the 60% that have 1,000 or less. Okay, the reason I spent so much time going over this is going to introduce us into the idea of retirement accounts and why you have to, you must max out what you are putting into your retirement accounts as soon as this webinar is over. Don't wait. 79% is the first number in this next sequence of working Americans work for an employer that offers a 401k. That sounds really, really good. 79% of working Americans work for an employer that offers a 401k. And we'll get into the details of what that means for our international people. You've got similar things, but we will get into that in the second hour and the third hour. Okay, so a huge percentage of working Americans work for somebody, some corporation, some entity that offers a 401k. But look at this next number, 14. 14% of all employers in the USA offer a 401k. Wait a second, that's impossible. Something's screwed up here. 79% of all working Americans work for an employer that offers a 401k. 14% of all employers in the USA offer 401ks. How can that be? There's only one explanation if both those figures are correct, and both of those figures are correct. And that one explanation is that only the very, very, very largest corporations offer 401ks. But they happen to have a huge number of employees that benefit from it, which means the probability is tiny that you work for an employer that offers a 401k, because those that do not offer 401ks are small and mid-sized companies. And even many or most of large companies don't offer them. But the ones that do offer them are enormous. Okay, let's see what that means. Walmart is the largest employer in the United States. It employs 2.4 million people. The top 10 employers in the United States employ 6 million employees, which means basically that number 2, who happens to be Amazon, employs far less than Walmart does. The next number is 32. 32% of all employees have 401ks. Now, this is where I don't want to swamp you with the numbers. I want you to get the general picture of what I am saying so you can plug yourself in yourself by what you are doing and what you need to do into the general sense of where this is all going. 32% of all employees in the US have 401ks. But remember what I said with that number 79. 79% have access to them. What does that mean? It means that 55 million out of the 160 million have chosen not to use this gift. I haven't explained why it's a gift yet. I'm going to. I just want you to understand that very few people are taking advantage of something that is being offered to them, but very few people are offered it. You have to be very special to have the offering given to you. You have to work for a very large corporation, and most of the people that do don't take the gift. Here's the gift. And we'll talk much more detail about this later. But the gift is the difference between not accepting this gift and accepting it. And this is simple. You can do these charts yourself. You can look it up on Google. Just look for the differential between tax deferred return and taxed returns, or tax deferred investments relative to non-taxed investments, or retirement accounts versus brokerage accounts over various time periods. You get the same conclusions no matter what you look at. We built this, my son helped me build this morning just off of a spreadsheet. And what it basically does is it shows if you start at zero and you max out a tax deferred investment like a 401k, which is approximately $18,500 a year that you can put into it, or you don't do it, you don't accept that gift from your employer, and you take the same $18,000 and you put it in a brokerage firm or a savings account. And assuming that you can get the same return on that investment in both cases, and we're going to assume 8%. We might have assumed 7.5% rate here. I think we assume 8%. We assume an 8% return over every single year over this period of time in both cases. Both the one that put it in the brokerage account because they didn't want it tied up in these things called a retirement account, which is the biggest excuse people use for not doing it. You both do exactly the same things. Or you could even say the same person does both things. You can only put $18,000 into a 401k each year. And if you do that, you've got, let's say you've got enough money that you can put $18,000 into a brokerage firm each year. Here's what will happen to both of those accounts for you individually or you and somebody else. It doesn't matter. In the first case, the blue line with the tax deferred returns at the end of 40 years, if you're 20 years old, you're now 60. If you're 30 years old, you're now 70. I'm now 70. If you're 30 years old, obviously, or 40 years old, then you're 80. But this kind of has everything in it. What it shows is about year 20, you're a millionaire by just doing this simple thing. You are not yet with your brokerage account, but you're not far off. But by the age of 30, you've got over $2 million. You've just gone above the $1 million mark on the brokerage account or a savings account that's paying you 6%, good luck, or 8%, good luck. It has happened in the past. Don't count on it. But by the end of the period of time, you see you've got almost $5 million in one account, a little over $2.2 million in the other account. The difference between those two lines is the gift. But it keeps on giving much greater than this. You can either try to duplicate the blue line by doubling your investment returns, which means taking a lot more risk than just buying an S&P 500 index and holding it without ever changing it over that full 40-year period. If you buy an S&P 500 index back in 1926 when it first came out and you held it to today, you'd receive 10% return per year on average over the entire period. We're just assuming 8%. This is a no-brainer. You don't need Hyperwave. You don't need Selgin. You don't need consensus. You don't need short-term. You don't need intermediate-term. You don't need long-term. You don't need anything. This is a gift given to you by the U.S. government, and you don't have to give anything up, except there are a couple of slight disadvantages that we will cover in hour 3, but they are so slight you don't even need to consider them. but we will consider them. Okay, that's what the gift is. Now we're going to go back to...
Jump in real quick. If you want to take it back one screen, just a couple of things that I could say.
Great.
And first thing I wanted to add is that you're painting a very bleak picture of the finances of the average American. Was that the average American or the average person?
That's the average working American. That's the average adult in the United States. Range from 18 to 120 years old.
And we can probably assume that we're probably on the higher end of net worth in terms of we're a first world country, and we are
absolutely
definitely on the higher end of that spectrum. So there's a very bleak picture being painted about the personal finances of the average person, not only just in America, but also across the world. And I'm not going to go into too much of a tangent, but I have often referred to this as the financial dark ages. And I firmly believe that people are illiterate right now as it relates to their personal finances, completely illiterate. And that is something this is not a normal situation. To have 34% of citizens have $0 to their name, and another 35% have less than $1,000 to their name, when $1,000 can't even buy, a car. I mean, $1,000 really isn't worth that much today. So that is an environment that is entirely unique, and it is probably even worse than the situation that Tyler, the picture that Tyler painted. And the reason being is that doesn't really take into account the average debt. If somebody has $0 to their name and they need to change their tires, well, they're going to have to go put that on their credit card. Somebody with less than $1,000 to their name is almost certainly going to have more than that on their credit card. So these people that have less than even $5,000 to their name, the large majority of those people have more in credit card debt than they have in savings. So that is the real issue, and one that is a ball of wax that can get so far out of control in a very short amount of time that we really want to help people to open their eyes towards not only just the retirement aspect, but also the keeping debt and liabilities down, which will in effect allow us to contribute more into a retirement account. So the second thing that I did want to say for anybody that maybe is listening that is a little bit younger, one of the biggest challenges that I had trying to sell financial products to younger people was that people that are 20 or 30 years old really are not thinking about retirement. Most people at that age, retirement is the last thing on their mind, and that is a big, big problem. And this chart right here shows that. Notice how the blue and the red lines don't even really diverge after 10 years. After 10 years, you've basically got the same amount of money, regardless if it's in a retirement account that's getting fully taxed or not. And that's because you haven't had a whole lot of earnings after 10 years. And then after 20 years, you're starting to get a little bit ahead of the game. But really, in those first 20 years, you're not seeing a whole lot of advantage of having a retirement account. I'm not saying this to dissuade the older generation from opening or maxing out retirement accounts, but I am saying this to try to illustrate how important it is to younger people, specifically 20, 30, even 40 years old. If you can give a retirement account 30 years to work for you and to work in your favor, that's when you're really going to start to see a big difference in a tax-deferred retirement account versus a taxable account. So the amount of time that you have in a tax-deferred account is basically the most important factor. The amount of returns that you're getting is, of course, that's going to be also the next most important factor. So if you've got time, that allows you to kind of have your cake and eat it too, in the sense that Tyler mentioned you can try to make up for some of this by being a little more aggressive and going for larger rates of return. That isn't really advisable for somebody that's getting closer to retirement. Once you're really getting closer to retirement, you don't have as much time to live through a 10-year bear market. You really don't have as much flexibility to take on more risk because you have less time. So somebody that's younger, not only do they have the time to really fully take advantage of these tax deferred accounts, they also have the ability to be a little bit more aggressive. It's very common that the younger you are, the more aggressive you can be with your allocations, because the longer your time horizon is. If you go through a 10-year bear market, you can just hold right through it and not have to worry about needing that money tomorrow to pay your bills. So just a couple things that I wanted to add. First of all, how afraid I am of our current environment about nobody having any real net worth. That's a balloon that is getting blown up, a rubber band is getting pulled so wide that it's going to have to break. Something is going to have to break. We cannot continue. We've been trending this way for 40, 50, 60 years, primarily since leaving the gold standard, in my opinion. And this is a trend that cannot continue for much longer. And hopefully, by what we're helping people to learn, will help break some people out of that horror cycle of not having any money and then needing to take out debt to pay for what you didn't have money for.
Great points. Thank you. I couldn't agree more. Okay, now we just talked basically with an example of a 401k, how many people are in it, how many people are offered it. The shocking thing to me is people that are offered it and they don't take it. But here are other forms of retirement accounts and the amounts that can be put into them. And we'll just go through it very quickly. Annual IRA contributions were $5,500 in 2018. They're now up to $6,000. Be sure you put in $6,000 into your IRA. Don't wait until April the 14th of the next year, which you can do. Put it in now. If you can't put it all in now, put in $100 now. Next month, put in another 100. If you get 500, put that in. Keep it going until you max out whatever your contribution limit is. That's if you're under 50. If you're over 50, you could do $6,500 last year, $7,000 this year. Annual 401k, 403b. 401k is for citizens in general. 403b are for teachers specifically and others. 457 these are just IRS codes within the code. There are sections having to do with retirement accounts, and each of those different ones is a different section. 457s are basically municipal workers and government workers. Under the age of 50, you can put $18,500 in last year, $19,000 this year. If you're over the age of 50, $24,500 this year, $25,000, $24,500 last year, $25,000, etc. Maximum annual additions limit under defined contribution plans, $55,000. You got to look into that. Talk to your employer. Almost no employers will do these maximum contributions. Some of them do. I gave this presentation or a similar one a year ago to my son's corporation that only had about 45 employees in it. So it's a small company. But they offered this tremendous additional contribution that we're not going to go into how, because so few people can get it, but it's there. It's on the books. It can be taken advantage of. Maximum includable compensation for imputing contributions, 275,000 going up to 280. In other words, if you've got over $280,000, you're maxed out on what you can, the amount of compensation that can be included in your calculations. Then they've got things called maximum simple salary deferral limits, 12,500 as opposed to 13,000, et cetera, et cetera. So we're not trying to say that if you don't have a 401k, you can't participate. Everybody can participate. If you're working for yourself, you can use a simple IRA. If you leave a company where you had a 401k, you can roll that into a rollover IRA, or you can keep it at your existing company in their 401k plan. We're going to talk about that in the second hour and the third hour, about the logistics. And the more we get down into the weeds, the more everybody's eyes glaze over. And that's why we started off with the big picture. The big picture is how few of you are participating, how everybody needs to participate, and how many choices you've got to participate, all of which, regardless if you can only put in $5,500 or you can put in $55,000, the principles are the same. You don't want to take this money and put it into a savings account until you have maxed out what you can do in your retirement account because of the chart we just showed you. There is something else that you need to understand about this chart. This gift that comes under the form of ERISA law back in 1974 and 75, where we made the switch. Remember what we talked about right at the beginning, which is just unbelievable. And Socrates, I don't think you got to see this. In 1980, 60% of non-government workers had a defined benefit pension. Today, it's 4%. That's what Socrates was just talking about. It's been since the mid-70s that this movement has taken place, and you need to understand what the movement is I'm talking about. It used to be that corporations that you worked for took care of you for the rest of your life. It used to be in Japan, that was the only way business was done, and it is still done that way to a great extent. But it is not in the United States, and it's not in most developed countries. Corporations could not keep up with making the payments they were promising to their workers. And it wasn't just a promise, it was a legal obligation. And because they could not keep up with the assumptions they were making about what kind of returns their investment would need to actuarially pay for their employees when they retired, that a gap began to develop between what was in the pot, like in Social Security where there is $0 today, and what is in that, and the amount that is needed to pay actuarially the employees that are supposed to be paid. And because of that, we switched from defined benefit programs, which you're looking at here on this slide, to defined contribution programs under ERISA, which includes the 401k, 403b, 457, IRAs, Roth IRAs, simple IRAs, rollover IRAs. All the stuff we just looked at is new stuff. Now, if you're born after 1980 or 1985 or 90 or 95, this doesn't matter. If you were born before that, in 1980, I was already 31 years old. I already had pensions. being paid to me because I had worked for a couple of little companies, one for 6 months. I forgot all about that, but it turned out I had a pension that was discovered by my daughter in a box 30 years after the fact that said that I had $600 owed me in this pension. Well, that pension had grown from $600. They didn't have to pay it until the 30th anniversary. That's the way this screwy thing was set up. But on the 30th anniversary, which had already occurred when I found that I had this in this box, that $600 had grown to about $2,000. But more importantly, besides them having to pay me out the $2,000, they've got to pay me $64 a month for the rest of my life. That's the way pensions used to work. But then after 1980, where 60% of all non-government workers had one of these things, it's down to 4% today. It's almost impossible for you to be one of those 4%. The chances are more like 20 to 1 that you are not one of them. Okay. Now I'm going to just, well, maybe what we are going to do, because we have just eaten up the first hour, is we are going to look at the international situation in some detail, but only enough detail to show you that if you are listening to us from Australia or UK or France or Germany or South Africa, that you fall into the same bucket exactly. Don't worry about the details. The details of how much, what you can write off, what your choices are, that does not matter nearly as much as whatever you are being offered, you want to max it out. And we'll go over about 6 or 7 countries that I've actually dealt with individual consulting clients. They all have different names. They don't call them 401ks. They don't call them IRAs. They have funny names for them, but they're all set up to do the same thing. So I'm going to just take a couple-minute break and then be right back, and we're going to get into a worldview of this thing, because as Socrates pointed out, the big overriding issue that Lucid Investment sees as in trying to bring to everybody's attention is the world debt problem. And the world debt problem is made up of all of the countries' debts relative to all the countries' wealth. Then all of the corporate debt relative to all the corporate wealth. And then all of our personal debt compared to all of our personal wealth. And when you take all of those into consideration, Lucid Investments believes we have gone past the point of no return. But there are still things that you can personally do to prepare for what is inevitably going to come. And number 1 on that list is, when we are done today at 3 o'clock, to set up a retirement account and to fully fund it and keep doing that, because that will be yours forever. And I will explain what that means to me as we get on with this in the second and the third hour. So I'm going to just break away for a second, and then we will come back and we will start by looking at what's going on around the world. So thank you very much. I'm going to leave screen share here and go back to this. And I will be back in just a bit. And welcome back, Socrates. And we're going to go right back to screen share and start looking at what's going on around the world. Remember, we use that number, $20 trillion, is the total amount in pension funds around the world, including in the US, which sounds like a very big number until you divide it by the number of people in the world. And then you come very close to the same kind of numbers we saw in the United States about how much of that, when you spread it among all the adults in the world, is available. And it's shockingly low. So we are going to go back to screen share. And we will pull this up. And we should be looking at Germany. Now, I didn't do any of these in any particular order, other than we've got consulting clients in each of these places. And what I just wanted to do is show similarities yet differences between what we just talked about in terms of the United States and what goes on in most of the developed world. In Germany, deductions from compensation, meaning your pay, are made for 4 social programs: retirement, unemployment, health insurance, and nursing care. Now, as you go from country to country, this stuff varies, but retirement's almost always one of them in there. Employees' contribution is tax deductible up to a certain limit. That's what stood out for me. That's the same as in the United States. And we didn't talk about that, but that is part 2 of the gift that you get in the United States. So just remember that. We have not yet talked about the fact that when you put this money in, it's a benefit. All we've talked about is once it's in the program, how it compares to somebody with the same amount of money not in a tax deferred program. We haven't talked about the tax deductibility up front. And here we see in Germany the exact same thing. In Australia, it took me forever to understand what was going on down under. We've got a number of clients down there, and they kept talking about this superannuation, which is their name for a retirement account. Partly compulsory, which is always a scary word for those people that are libertarians. Further encouraged, which is always nice, by tax benefits. Employers' contribution rate to grow to 12% by 2025. In other words, the amount is going up that is being offered in various locales, what employers can contribute. In the United States, it's been 6% matching that can be given for by certain companies, where if you put in a certain percent of your pay, they will match it up to a certain level. If those 2 things together don't make it all the way up to the maximum amount you're allowed under the law, let's just take the $18,500 for a 401k. Let's say you put in 3% and your employer matches 3%, but the dollar amount of that is $15,000 a year. You can still put in more yourself. It's just that the employer won't match that. And my recommendation to everybody is you max out all the way up to what the company will pay or the organization will pay, and then you max out all the way to the maximum yourself. And we'll talk about the disadvantages of doing that, the excuses you have, the excuses I have for not doing it. There's always something coming up. I can't do that this time because I want to take a vacation. I can't do that because my kids are starting school. I can't do that because you've got to overcome that, because this benefit is so enormous. It offsets all of the excuses you can have. In the United Kingdom, and everything we're showing you changes constantly. That's what policymakers do. They change legislation, change amounts, change things that are taxable and non-taxable, tax loopholes they close, tax benefits, depending on who's in office and all the rest of it, which is why the tax code has got so many thousands and thousands and thousands of pages in it. But here in the United Kingdom, employees can gain income tax relief on contribution up to £40,000 sterling for the tax year 2018-19, unless they have taken money from their pension savings in a flexi access way, or their total income is more than 100. That's why you need CPAs. That's why CPAs are in business, to interpret all of this nonsense that goes into taking a simple idea and making it workable and making it understandable. In this case, I've had so many people from the UK tell me what a nightmare it is to try to figure out what they can do in terms of tax deferred retirement planning or healthcare planning and all the rest. It's constantly shifting. But what is ever there that is given to you where you don't have to do anything but contribute to it, and you can get tax benefits from it, and you can grow that pension savings, they will always throw some kind of a penalty for breaking that chain, for breaking what they are attempting to achieve. And we'll talk about that in the US, about under disadvantages of putting money into a retirement plan. And I will minimize that, not because I'm trying to sell you a retirement plan, but because I'm trying to sell you on the idea that I've thought through this for 40 years and have come to these conclusions, that no matter what the hurdles are, no matter what the perceived disadvantages are, overcome them and go ahead and put as much as is allowed and take as much as the benefit as you can get, regardless of where you live. In Sweden, we found that overall spending is constrained by a fixed contribution rate of 18.5% of covered wages. A portion, 2.5% of wages, is devoted to a straightforward defined contribution pension. In other words, like our IRA or our 401k. Workers get fully funded individual accounts, which are invested in privately managed investment funds. It resembles a 401k plan and IRAs in the United States. So even though there is a socialist democratic bent to many of the Scandinavian countries, more and more they're beginning to resemble what we do with our 401k plans and our IRAs. The numbers differ, but the principles are the same. In South Africa, we found that contributions by employers to both pension and provident funds, they're called, are deductible from their incomes. Contributions by employers to both pension and provident funds are deductible from their incomes as expenses incurred in the production of income. That's fairly common, and one of the reasons why corporations are incented to setting up plans like 401ks and then making contributions into them, because it's deductible for them. It's also deductible for you when you put money into them, and we will get to that later. Any contributions to pensions and provident funds by employees, by you, and by employers for their benefit are up to 27.5% of qualifying earnings or 350,000 Rand, whichever is the lower. So they almost always put limits on how much you can put in and what income levels that will change at. So forget all of that stuff. Whatever it is that they're giving you, that's what you want to take, and you want to max that out. Then this goes on, and there's a lot more detail. Any contributions exceeding the limitations are carried forward to the immediately following year of assessment and are deemed to be contributed in that following year. The amounts carried forward are reduced by contributions set off against retirement fund lump sums and against on and on and on and on. You can read thousands of pages of stuff explaining this in every country. One of the reasons, very obviously, that so few people participate is it seems to be so difficult to understand, and it should not be. It is very, very simple. One or two or three very simple principles. All the details, if you can't figure them out, just go to that page that shows here's the maximum amount you can do, and do your level best to do that maximum amount. Let other people figure out, exactly. H&R Block and others can figure out exactly how much more you could have or should have put in. Just do the best you can. In Spain, private pensions in Spain consist of individual pensions and collective pensions, which of course are divided into two subcategories: associative and company schemes. Great word, schemes. Then down below, approximately 50% of the population are covered by one or both. The schemes benefit from tax subsidies whereby individuals can contribute up to €8,000 per year free of income tax into either scheme. By 2009, approximately 8 million people in Spain had individual pension plans, and 2 million people were covered by company pension plans. Now, a lot of these are new innovations demanded on by employees through either collective bargaining, through unions, or through the political left or the right. Doesn't matter the details. Whatever is offered, you want to take in almost every case that we see in the developed world. They have many similarities, but there are many differences. One of the more recent things that has happened is in Hong Kong, up to 60,000 Hong Kong dollars annually in tax deductions to individuals who buy deferred annuity products or contribute beyond their MPF mandatory level. A couple's limit is up to 120,000 Hong Kong dollars, and they can divide their contributions on their tax forms as best suits their circumstances, as long as neither declares above $60,000. Almost everywhere we look, we see structures similar to this with little bits of differences, and we can help walk individuals through the questions they need to ask. Anyone, including lawyers and CPAs, will get completely bogged down in the minutia. Don't worry about the minutia. You just need to know a couple of things. How much can I put in? What can I write off? How easily accessible is this money at what time? What are the penalties for taking money out early? Now, we are going to go, I'm going to go off screen here. Because one of the things we're going to talk about for the next half hour and the last hour aren't going to be the reasons why you should be doing this. I hope I've made clear what the reasons are. We're going to talk about the limitations and the practical side of once you've got one of these things set up, what you do with it. you do the same thing you would do in general, given your skill levels, that we talk about in all of our other vlogs. If you are really studying investing, both fundamental and technical, if you follow Graham and Dodd and Warren Buffett and value investors like Ron Barron and all the others, Bob Rodriguez, all the other great value investors, or if you follow the great growth investors and their techniques, how they look at companies fundamentally, or if you don't do any of that stuff and you just buy indexes, you go by what John Bogle at Vanguard said, is just buy an index fund and hold it forever. There are many, many ways of looking at this, but don't confuse yourself. What you want is you want this platform to work with. You want an IRA that you can put in $6,500 or $5,500 a year, which keeps going up, and they're going to try to keep forcing those limits up. But whatever it is, max that out. It used to be, I remember, $1,500, and then it went up to $3,000, and then $4,000, $4,500, $5,000, $5,500 in an IRA over time. And so it didn't seem like very much money, but back then money seemed like it was a lot more. So $1,500 back then is basically equivalent to $5,500 or $6,000 today. Whatever that number is that you can qualify for, you want to set it up. It is not difficult to set these things up. You can do it online. You don't have to fill out any paperwork. You can go to fidelity.com or schwab.com. You don't have to talk to anyone. You press a couple of buttons and the account is set up. And now all you have to do is fund it. And you can fund it $50 today and $150 tomorrow. And you've got a whole year to get up to that max level. What you want to do is figure out a way to do that. Convince yourself that there are no downsides, there are all upsides, and the upsides are greater than almost anything you will ever do financially for yourself and your family. And I know those sound like they're wild, hyperbolic statements. They're not. They're absolute truth. Truth is not absolute in this realm, but it comes awfully darn close. You've got to do it. And once you've done it, then if there's anything left over, do things with it. And if there's nothing left over after you've funded this fully, suck it up. Wait another year, wait 18 months, wait 2 years. Get it fully funded in that next year, and if there's something left over, use it. Have fun with it. Or start putting it in a brokerage firm or a savings account, which is a great feeling when you can do both. But first things first. Get set up, whatever you are qualified to get set up, accept it. Don't be out of that 79%, don't be that small percentage that has actually accepted what your employer has offered you. Now, after Leah and I did this basic talk in a 1-hour vlog, we had a number of people that within days or weeks said, the first thing I did is I went out and I set up an account, and I want to thank you very much. And we've had some people set up 2 accounts and 3 accounts and 4 accounts. And there's ways of doing it. You can work at a place, but once you've reached your max, that's all you can do. But if you've moved from place to place, you might have several 401ks and an IRA rollover. And then you might not work for somebody for a year or 2 years or 3 years. You want to be sure you set up an IRA if you're working for yourself and you're bringing in money, because you can write that off of your income. So let me just talk about that for a second. how it works. Let's just say you're making $50,000 a year, which probably puts you in a 25% tax bracket. It might be 30 if you live in a state where there's state tax and a municipality where there's municipal taxes, that number gets up there pretty good. But even if you say a third, you're in a 1/3, 33% tax bracket. You're making $50,000. What that means is, after all the deductions and contributions and charitable stuff and back and forth, let's just leave all that out and just say you've got pay stubs that show $50,000 in income. You did so much in withholding, and now you have to pay your tax, and you're going to pay a third of $50,000. So that's something on the order of what, $17,000, $15,000, $16,000, $17,000 is going to go out in taxes. Let's call it $15,000. So instead of you at the end of the year having that $50,000 you thought you had, you don't. You've got $35,000. Well, that's inevitable. Now, you can move to a state that doesn't have state tax. You can change your life. You can do different things. You can move out of the country and try to find a place with a better tax deal. But let's just keep it simple. Well, with $35,000, if you've paid everything out, let's say you end up with $5,000 left that you could actually put in savings. Now you've got a choice. You can put it into a bank, a CD, a savings account. You can buy an insurance annuity. You can do different things with it. Or you can do what I am now not as strongly suggesting as I can you should do, which is you want to put it in a retirement account. Anything that's left over. If nothing's left over, I was going to say put it on a credit card, but that would be irresponsible, so I'm not going to say that. There's something left over, let's call it $5,000. You want to put it into an IRA, and you've got until April 15th of next year to do it this year, which means you can start now, figure out it's going to be about $5,000 and start doing it. It's tough to write out a check for $5,000. We've already seen that 85% of the people in this country, adults, cannot do that at any point because they don't have it. So first of all, if you can do it, do it. You are blessed by being able to do that. You will be further blessed by having done that. So you take the $5,000, you put it into an IRA. Let's say you set it up at Fidelity. It takes you 5 minutes. At first, you're confused. You call an 800 number, and like that, you're no longer confused. It is that simple. It's a couple of very quick entries, and you are set up, and you are legal, and you are ready to go. Now you put that $5,000 into that account, and you don't do anything with it because that's step 2 that we'll talk about later on in this hour and for most of the next hour is what do you do once you have a retirement account? How is it different, or is it different than everything we've been teaching for the last year and a half about hyperwaves and consensio and short-term and intermediate term and what kind of international and all that stuff? Forget all that. All you do is you put the money in. It immediately goes into cash. You get to choose, you want a tax-deferred account, tax-deferred money market fund, you want a regular money market fund. Don't expect to be paid a lot of money on that, but you will be paid money on that. There is some level of interest that you will get by just sitting in cash. It's not going to sit there like fiat money and $100 bills. It will actually grow slowly over time. As interest rates get higher and higher, that number gets higher and higher. The highest I've ever seen was you used to be able to get over 20% on money market funds. That was all the way back in 1979. Since then, interest rates have come way down where you don't get anything. But you don't get anything in a savings account either. You don't get anything in a checking account. You don't get anything in a CD. And when I say that, you know what I mean. You barely get anything. Okay, what have you just done? Well, remember you had $50,000 and you paid out $35,000 you kept $15,000. Nope, you kept $35,000 after you paid 1/3, which was $15,000 in taxes. Now let's assume the year before you had taken my advice and you took the $5,000 out and you put it in before April 15th of this year. Into what? Into that Fidelity account that it took you 5 minutes to set up. So now it's not in your bank, it's not under your mattress, it's at Fidelity. And it happens to be insured up to $250,000. Okay, what just happened? What happened is you have just reduced your taxes. They're not $15,000. Your taxes for 2018 would have dropped by 33% of $5,000, or about $1,500 or $1,600. So instead of paying out $15,000 in taxes, you only pay out $13,500 in taxes. You just got a gift of $1,500 by picking up the phone and calling up Fidelity or Schwab or E-Trade or you name it, doesn't matter, Merrill Lynch, Wells Fargo, anybody that offers an IRA. By that simple step, making the decision, I am going to max out whatever I can every single year in whatever is available to me at that time. If it's a 401k or a Roth IRA, an IRA, we'll talk about Roth versus simple, but don't get hung up on that stuff. Go for the big themes here. I flip a coin, Roth IRA, not Roth IRA. Or you talk to a CPA and they'll go on for 6 hours why one is better than the other. It's a toss-up. One, you put money in after tax, one you put money in before tax, which means one at the end you take it out tax-free, and the other one you have to pay taxes on it. Okay. Do all the calculations you want. To me, it's a coin flip. But,
I could chime in on that real briefly if you don't mind.
Sure, please do.
I think it can potentially be more than a coin flip depending on a personal situation, and as briefly and quickly as possible is that it will determine your tax bracket now compared on your tax bracket when you retire. If you're expecting to have a higher tax bracket when you retire, then it would be best to pay those taxes now when you're in the lower tax bracket. For me, I'm young. I feel like I'm financially savvy. I'm working hard to make good money. I'm expecting to have a higher tax bracket when I retire. I want to pay off my house. I won't have that to write off anymore. I want to make more money. So therefore, I expect when I'm 50, 60 years old to be in a much higher income bracket than I am now. And therefore, if I am deferring taxes from today until then I will be disservicing myself by not going ahead and paying those taxes now while I'm still in a lower tax bracket. Now, that is all based on my projection of where I think I'm going to be. I could be wrong, and in a sense, it is a lot of guesswork, and it is kind of a coin flip. But if you have reason to believe that you'll be in a higher tax bracket when you retire, maybe you don't have dependents anymore, you don't have kids in college, there could be good reasons to believe that you would be in a higher tax bracket when you retire, and therefore you would, in that circumstance, if you are right with that projection, you would be best in something like a Roth where you're paying those taxes down now and then not having to pay those taxes in the higher tax bracket. And what I'd always suggest when I was licensed as a financial advisor, I'm not anymore, but what I would suggest was somebody who's kind of unsure, you really don't have much of an idea, you can go with both. Why not? If you got $5,000 to set aside, you could put $2,500 into a Roth and $2,500 into a traditional. We don't want to make it too confusing for you, because Tyler is right. What really matters is that you get money into a retirement account. That's what matters, and you don't want to get bogged down by the minutia. But it is an option if you are thinking, I don't really know which one to go with. You can go with both, and then if it turns out one really was in your benefit, at least you got some exposure to that sort of tax vehicle.
Yeah,
so
that's a great point. But the greatest point you made was the one that I've been making, which is first make the decision you're going to do it, and then do it. And then the second decision is where are you going to do it. The third decision is make projections and decide which one makes sense to you. I'm not that smart. You know, I always thought that what would happen, you can retire basically when you're 67. That doesn't mean you have to take any money out. You don't have to take any money out till you're 70 and a half. And what most people do is when they are retired, their income drops to zero. Because they've got savings, they've done other things, they've bought houses, and they've got all this money sitting in a retirement account. Remember, I've promised you you're going to be a millionaire at that time. The important thing isn't getting down into page 16, subchapter A, asterisk, asterisk, and trying to figure it out. It's just doing this simple thing, putting as much as you can in to any one of these things, and just keep doing it. And when you are retired, you will have $1 million, or two, or three, or four. If you did it in a brokerage account or a savings account, you've got about two. If you did it in one of these, you've got six. That's the difference. Now, all the rest of it is important, and I don't mean to minimize it, but I always try to simplify things for myself. I don't like complexity, so I take very complex things and I work with them and work with them and work with them until I understand what it is, and then that's the thing that's important to me. And that's what I'm trying to say here is what you want to do is get the structure set up and get the process started. And don't wait till tomorrow, because if you wait till tomorrow, you will wait until Monday. And then the following week, and then the month, and then it's gone. And then you need to be slapped in the face by listening to something like this before you wake up again. And you don't get that opportunity very often. It's just too easy. Why so few people take advantage of this gift that has been given you. Take it. It's huge. It's enormous. You can't believe how big it is. It will give you more money than you have earned. This simple system will give you more money over the years than you have earned in salary. If you're making $50,000 a year, how long will it take you to get $6 million? So the point is that this isn't incremental advantages. This is the biggest thing you can do in finance. Now, that's not exactly true. The most money I have made, and there are three ways to make a whole lot of money. This is one of the three, but you got to do it. This is the only one that guarantees you will be a millionaire. The other two, you can make a whole lot more money. The way I made the most money was by working for a corporation that had stock options and was traded on the New York Stock Exchange. And I happened to be in a position where I got a lot of stock options over a long period of time. And another corporation came out and bought the corporation I was with. That's it. That's the lottery. You can't count on any of that stuff. You can't count on that company that's giving you stock options if they're worth anything. Look at the dot-com bubble. Look at what's going on with these ICOs. It doesn't matter what it looks like you're getting. If there's no substance behind it, it disappears. And many corporations that have stock option programs, you can go for years and years and years and years and years, and the stock doesn't do anything. It goes down. You've got a lot of pieces of paper, and there's nothing to show for it. In the rare example that I just gave you, that's where you see the huge money by CEOs. CEOs, yes, some of them get paid a lot of money. That's not where they make their money. They get their money off of stock options. So does the executive staff. And it gives them the enthusiasm and the confidence and the reason to work hard to make the company better. Because now you've got 10,000, we had 10,000 employees in the bank. And I was lucky enough to be in the top 1% of those that are paid. Lucky enough, except for taxes. When this transaction takes place, when one public corporation buys another corporation, if you happen to be in that small minority, you get hit by double taxation on the amount that you get. None of the other employees do, so I say it's both a good thing and a bad thing. The good thing is that I was in a position that over years I was paid a lot of money and therefore had a lot of stock options along with that. It's bad because then it puts you in the crosshairs of the IRS and political parties and other people, and they have a way of extracting that from you. But that is the way that where you see the biggest fortunes over the last 100 years being built, that it was built from corporate stock in good corporations. So go out, throw a dart at the Wall Street Journal and say, I want to go work there. And that's about the probability you have of having that all work out right. But when it does work out right, it's great. Number two, without any question, is the real estate market. It might be number one because so many more people have made enormous amounts of money in real estate than in what we talked about in scenario one. Scenario one, if you're the president or the CEO or the chief financial officer or one of the top people on the executive staff, you can do unbelievably well, much better than worrying about your retirement account. Number two, and almost everybody can and does and has done this to some extent until 2007, 8, and 9, and now everybody's scratching their head and saying what went wrong, is it in real estate.
All right, I'll jump in real quick because I think that I might have taken us off track a little bit. And there was a question in chat that right now isn't the time for questions, but I did want to make sure that I'm not confusing everybody. So question from Shelly is, I feel like I just missed something. If I do have an active 401k, I don't need an additional IRA right now, right? Just if I have to roll it over or I'm self-employed, etc. Correct. And correct, she asked with a question mark. And I just wanted to say that that might have been confusing what I was talking about, but I wouldn't necessarily agree with what you're saying. When you say if I have a 401k, I don't need an additional IRA right now, is that right? What I would be asking yourself is, can I afford an additional IRA? You don't necessarily need it. If you're maxing out that 401k and you're doing that over a consistent period of time, then you're going to be in good shape. But if you still have an additional income coming in and you don't, and you've got other IRAs that you are qualified to fund that you're not funding, well, then why not? Why not go ahead and open an additional IRA? That it is absolutely well within reason to have a 401k and also have an additional IRA. And specifically, you would want an additional IRA if you're maxing out the 401k. You've reached those limits. Now you can't put any more money in there, but you still got extra money coming in that you're looking to house in a tax-deferred environment. Then you absolutely could look into opening an additional IRA. But I'm not necessarily saying that you need to, but if you can, then absolutely, why not?
Yeah, that's a great point. And that's where things get a little bit sticky having to do with your spouse's income, your income, if you're filing jointly, if you're filing separately, where the income's coming from. Your spouse can have IRAs or 401ks from their work. You can too. Once one of those pots is filled up, if you've got other income, it can go into its own bucket. But then you have to start checking to make sure that the total amount of buckets don't take you above income levels that we showed on that one screen that max everything out. You can't go above a certain level. Some countries we looked at have those kind of restrictions. So just trying to keep it simple then. We're talking about now, what do you do when the thing is set up? And we were talking about when the thing is set up, what is important is that you get the tax write-off first. And you don't have to do anything, it's automatic, you simply have to claim it. And wherever you've set it up will give you the stuff at the end of the year that shows that you made the contributions. Okay. Then you can either fill out your own tax forms or have H&R Block or have your CPA just take that piece of paper and attach it to your taxes, and you've just saved that money. Okay, now we're on April the 16th, the day after you filed, the day after you qualified to put money in from the year before. Now you've got an IRA or 401k or something set up, and you got cash sitting there. What do you do with it? And that's why it's good for Socrates to be here for this part of this discussion. Because what we want to talk about is something very different than what you've heard us talk about. And Socrates and I have not talked about this, so this is going to be interesting for me too. And that is, do you approach what you're trying to do within that any differently, given the fact that this is a new structure? It's not your brokerage firm. It's not Gemini. It's not Kraken. This is something different. And we'll talk about crypto and retirement accounts, but not right now. Because I'm hoping that I know for sure that many of our listeners, they're not interested in that side of this discussion. They want to hear why they need to max out in everything available to them as a retirement account from a practical and an absolute and a real point of view. And that one chart says it all. But your thinking's got to change a little bit, I think. I know it does in my retirement accounts. I've had 401ks. I've had, I was in the military for 4 years. So you begin to qualify for things. There's all kinds of stuff called vesting, how long you have to be at a company before you can get into their programs. Sometimes it's a year, sometimes it's more than that. But we're going to put all that aside. We're saying whatever you can qualify for as of today, you want to do it and you want to max it out. But think of the difference between short-term trading in a brokerage firm and short-term trading in a retirement account. Let's just start there, real simple stuff. You know that what I teach is investing first, and I define that in a certain way, and then we go to shorter and shorter time frames and more speculative things. And as we go from the long term to the shorter term, from the very broad to the very specific and very volatile, that the total amount goes down. That's just the way I look at everything. That's what I try to keep all of our clients to do, and almost no one does unless they turn their money over in a discretionary fashion and I force it on them, because it's too easy not to do it the other way, to look at the short-term volatile things first, jump in and out, in and out, in and out. If you're really, really good, you do more wins than losses. But if you're most people, you don't. And then you get up to the little longer terms. Well, this is actually a pretty good company. I've read about it. I've read research reports about it. I like their products, all of this stuff. You take a Magellan approach to it, Peter Lynch. Get to know the products, get to know the companies, or you take a Warren Buffett. You study the company completely, their management, how they run their business, everything else, and then you don't just take a little piece of it, you buy the whole thing. But you're still buying something that's singular. You're buying a company, one thing. I don't like that because it's still volatile. It goes up and down. You make mistakes. Warren Buffett makes mistakes. Peter Lynch makes mistakes. You don't make mistakes as big out here when you're doing very broad indexes. You are going to do broadly what the markets do. Now all you've got to do is watch the long-term trends of the market. But I'm not going to lecture you on my style. I want you to think about this platform of a brokerage account compared to a retirement account. Because you're not paying taxes in the retirement account. Yes, you are in 40 years. Forget about that. Let's be real. Today, if you buy Google stock in your retirement account and it goes up 10% in the next 6 weeks, you can sell it and you've got a 10% gain and you're not going to pay taxes on it. In a brokerage account, if you do what I just said, that 10% gain gets added to your income and you will pay an income tax on it at the end of the year. If you're in a 50% bracket, you just gave away half of your gain, which is why people in the brokerage world, Wall Street world, say you don't want to make short-term trades. You only want to buy and hold. That's number one. What they really believed for years and years and years is that you couldn't make that call. You couldn't make the long-term call that a trend is changing. But they would back it up by saying, and if you do get out of this position, even though it's going against you, you're going to have to pay a tax and all that kind of stuff. You don't worry about any of that in a retirement account. What that tells me, and you're not going to hear too many financial planners telling you this, but I want to hear what Socrates has to say. You can go nuts in a retirement account. You can buy today, sell tomorrow. Buy the next day, sell the next day. Buy the next day, sell the next day. Put all of it into something very speculative. Just
Yes.
opposite what is taught and what you think and what is intuitive. Now I'm talking about the tax side of it, which is the difference between the blue and the red line. I'm talking about you are going to make much more money by the tax savings and the compilation of the compounding of your money in this structure. Therefore, you can do much more aggressive things. Am I recommending that? Of course not. Am I recommending that to those who have learned Hyperwave, learned Consensio, learned Selgin, learned the difference between long-term, short-term, learned all the other technical tools that Socrates had been teaching you? Yes, absolutely. If you have taken the time to understand what you're doing investing and not just rolling the dice or picking red and black, but you're studying it, what better place to use that skill than in a retirement account where you don't have to pay taxes on the huge gains you're going to make. Now, for everybody else that doesn't have the time or the wherewithal or the interest to understand that process of making decisions, you've got a very easy way out. You don't have to do it. Stick with real simple things like, is the long-term Consensio trend up or is it down? If it's down, get out of that S&P index you're in. You don't have to wait for me or Socrates or Tone or any other person that spends all their time doing that to tell you that. In 2 weeks, you can learn the intermediate and advanced Consensio and never have to hear me blab about it again. It works. It will always work mathematically. It will get you out of uptrends and before a downtrend. And if it's not in a retirement account, we'll talk about that in a minute, you can actually short it, which you can do in a brokerage firm, which you can't do. And that's part of our last hour. And we're going into the last hour right now, which is what you can and can't do in these accounts. But first thing I'd like to do is turn to Socrates, because he hasn't heard these crazy words before. And I'd like to see his thinking on that.
Yeah, absolutely. Very fascinating information, and definitely a lot to think about. There is some options in the retirement account as it relates. Like most people, when you hear retirement account, you're not thinking trading account. That's like mutually exclusive in most people's minds. And the benefits for actively trading inside a retirement account are very much cannot be ignored. And if you are the type of person who is actively buying and selling, and you are therefore subjecting yourself to some short-term capital gains taxes, then doing that buying and selling within the structure of a retirement account, the benefits could be absolutely enormous, specifically depending on your trading style, your prowess, and how much you are returning. We saw that chart earlier where an 8% rate of return in a retirement account after, 30 years? After 30 years was going to be $4 million. And if you were not in a retirement account, then you're going to be significantly less than half of that. So go ahead and think about, if you are an active trader who is actively buying and selling, whether it be swing trading, position trading, even day trading, if that is your preferred approach, then go ahead and go through some calculators and get an idea for how much you're going to save yourself by trading in a retirement account. If you're actively buying and selling, then you're probably trying to earn more than 8%. Otherwise, you'd probably be best to just buy and hold and sit on those hands. But if you are actually buying and selling and returning on a consistent basis more than 8%, maybe 12%, maybe 15%, maybe even more if you're in the crypto world, then go through those same calculators to see how much you're going to cost yourself by not utilizing the advantages of a retirement account. That you almost have to see the illustration to begin to wrap your head around it. So that is definitely something that now that we're getting more options to trade crypto in retirement accounts, that is what is extremely appealing to me. Back when in 2017, when I was really looking to get as much exposure as I could to crypto, I had no idea how to do that through a retirement account. I don't even know if I could have at that time. Maybe there was an option, but I therefore was moving money out of a retirement account and into crypto in order to try to maximize my returns. And that would be the only reason why I would be uninterested in trading in a retirement account as if I didn't have access to at least Bitcoin. And now that that is becoming possible, and it will only become more and more available as time goes on, as far as I'm concerned, that makes this extremely appealing, not only for somebody who is actually buying and selling in traditional markets, but for somebody like myself who is has a background in crypto and really wants to focus on the volatility offered there. So absolutely tremendous benefits, and there really aren't many cons now that we have the markets that are starting to become available inside a retirement account.
Great points. I agree with that completely. So it's something to think about. We've probably got about 250 or 300 people that have taken most of our courses. And I feel, they might not feel that way, but I feel that they know enough now to do what I'm suggesting, which is to use all the tools that they've learned in a retirement account, even if it means doing it on a short-term basis. I think they've got enough of a background. Most people do not, and so I'm not here preaching that everybody should set up a retirement account and then go crazy. Pick out a company that their brother-in-law told them about and put 100% of your money in it. Not in any way. You have to judge this yourself. We would be more than happy to talk with you and help judge you about what you can and should be doing. But people that are really studying this and understand the principles of investments should have no problem at all doing as much short-term trading as they want to in a retirement account. Now, I'm going to go back to screen share because I pulled up a fairly controversial subject, and Socrates just brought it up before. What we're talking about now is on April the 16th, after you funded this thing and you just put cash in, what are you going to do with it? And I'm not going to reteach you things that I've taught before, which is you want a very large portion of that for a very large portion of time for the rest of that life of that retirement account to be in very broad indexes. And you want, and I'll say 60%, and you want 25% in things like sectors and industries made up of many, 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 many different companies. The reason you want all of that is because now it's very simple for you to follow the long-term trends of those big things without getting bogged down in the daily swings of individual securities or very, very volatile securities, which if you're a professional, you're a doctor, you're a professor, you're, in any professional business where you have to have your time and your mental efforts focused on what you're doing to be able to fund everything in your life, you don't want to be distracted by playing games in investing and speculating. It's a fun little hobby, but don't take it more seriously than that unless you want to be a professional investor or speculator, in which case give up all the other stuff and do it. It is a profession. You don't need to do that if you use the principles that we've been teaching. They're very simple, but you've got to stick to them. If you try to get too cute and too aggressive and start using these principles on trying to make money on short-term swings, what it will do is keep you up all night. You will make a lot of mistakes. Your spouse will be very upset, and what your profession is will suffer. So it's one or the other. It's simple stuff. Don't mix it up. Okay. So what I want to bring up now is I want to bring up that controversial chart that asks the question, can I put crypto in these things? So to do that, I'm going to go boom, and there she is. Can I buy crypto in these things? The answer is no, you cannot do it. Stop it. Never could do it, can't do it now, except in very, very rare instances. And those instances are so rare that 95% of you that are doing it are in violation, and you will be probably caught. Okay, here's what we're going to talk about. Here is the wording that isn't shown to you when some new IRA comes along that's called such and such, and yes, you can put cryptos in it. Because the IRS treats cryptocurrencies, such as Bitcoins, as a capital asset, such as stocks or real estate, a retirement account is permitted to buy, sell, or hold cryptocurrencies. Well, that's easy. It says you can do it. Comma, subject to the prohibited transaction rules found under Internal Revenue Code 4975C. So let's take a look at that. The Internal Revenue Code does not describe what a self-directed IRA or solo 401k plan can invest in, only what it cannot invest in. Internal Revenue Code sections 408 and 4975 prohibits disqualified persons from engaging in certain types of transactions. Well, there's a wrinkle. So, what is a disqualified person? The foundation of the prohibited transaction rules is based on the premise that investments involving an IRA and related parties are handled in a way that benefits the retirement account and not the IRA owner. The rules prohibit transactions between the IRA and certain individuals known as disqualified persons. The definition of a disqualified person, 4975E2, extends into a variety of related party scenarios, but generally includes the IRA holder. But generally includes the IRA holder. Any ancestors or lineal descendants and entities in which the IRA holder holds a controlling equity or management interest. Most of the things you read on Twitter and in YouTube and are advertised do not protect you from being a disqualified person. There is a way of doing it, and I am telling you, it is very expensive and it is very complicated, but it can be done. And I'm not going to explain what it is because it would take us a whole show and we would need several CPAs that have figured it out and then several legal opinions giving you the protection you need so that not only is whoever set up that IRA for you not in trouble, but you yourself are not in trouble. So I just wanted to be very clear that I don't buy all of the stuff that we've been given about, oh yeah, sure, I've got an IRA and I've found an exchange that'll let me put it in this, or I've got a company that runs an IRA, they're named ABCDEFG out of Malta, and you can count on them. Or they're down in Panama, or they came from Luxembourg, or they came from the Seychelles. And they didn't really come from there, they actually came from X, Y, Z, or D. Come on, wake up. You can't do a lot of things in retirement accounts. You can't short stop in a retirement account. You can't put in cryptocurrencies. You can't put in almost all cases, stocks less than $5. You can't put in penny stocks. There's a ways around that, but you are under the gun if you are trying to do things that you are not able to do. And it isn't the IRS that determines this, it's ERISA, the Department of Labor. The Department of Labor is behind all of the rules having to do with ERISA accounts. Defined contribution, defined benefit, IRAs, 401ks, all of those numbers go by a very specific set of transactions that must be taken and cannot be taken under the rules. That's why I've been complaining to all of you for a year and a half that as an institutional investor, where I was managing defined benefit plans for very large unions and organizations and charitable organizations, that I couldn't do things I wanted to do. I couldn't get out of the stock market because you're not allowed to get out of the stock market. You've got to be in at all times, even if a meteor is ready to crash into Earth. You cannot sell your stocks. You can't raise more than X% of cash. You cannot short stocks. You cannot buy a lot of strange things like art. You cannot buy things like Chinese ceramics or racehorses. You can only buy liquid securities that are traded on regulated exchanges using what's called the prudent man rule. And the prudent man rule is ill-defined, but it means if you take the average man with common sense and get 1,000 of them in a room and ask, can I buy a cryptocurrency in my IRA? 99% of them will say, of course not. Because this thing was designed by giving you this enormous gift of free money and no taxation. And you're not going to get that for nothing. Everybody tries to get it for nothing by putting things in and doing things that they can't and shouldn't be doing. So all I'm saying is be very, very, very careful. I have 3 clients now that have figured out a way to actually do this. I have not read anything by the IRS or the Department of Labor that says they can, but I am convinced that their CPAs figured it out. And it is very complex. And if you want to go to a very high-end attorney, tax attorney, or a high-end CPA and pay them a lot of money, they can walk you through the steps necessary to do it where you can actually do it. There are big problems with doing it in terms of getting your money because it's no longer yours. You have to give it up to a LLC. And by doing that, it bridges a gap. And the gap that it bridges is this thing called a disqualified person. So that's not what this is about today, but I just wanted to touch on this for a second. Now, we've got a lot of questions that have been coming in. And I think we can, in the last 30 minutes, go through those, but I wanted to spend the next period of time talking about how you marry the long-term lucid investment strategies view of investing with this wonderful thing called retirement accounts. Because I believe there's a way of doing it that makes a lot of sense to me, which is the same thing we've taught everybody about their regular brokerage accounts, which has to do with the amount of risk that you're willing to take with the amount of safety that you need. Remember, you need an 8% return every single year on average. That means you can do a 4% year and you can do a 30% year. And a 30% year will basically give you 4 years of the kind of growth you need for me not to be a liar, where I told you that I will guarantee if you start with nothing, you will be a millionaire if you stick to this by the time you retire. So how can you marry those two concepts? One, I just said, go crazy. Speculate as much as you want. Do a lot of short-term trades. Go for the big kill. Try to get 10x, 20x, 30x on a trade. Don't worry if it's within a 1-year time frame. It's not going to cost you any tax money. And what I just said about that's not what Lucid Investment Strategy stands for. Lucid Investment Strategy stands for making sure you always get absolute returns, regardless of what direction an asset class or a market is going. That's what we stand for. Not the maximum amount of returns. I don't care how much money you make. If the markets are going up and you use any of my techniques, you're going to make money. Other people will make more money doing other things. I don't care. What I care about is following these rules so you don't lose money, so you don't drop below zero. And there's a way to marry those two things into our discussion of retirement accounts. Just try this for a while. Once you have funded your retirement account on after April the 16th, put 60% of the money into the S&P 500 if Consensio says it's in an uptrend. Put 25% of the money you've got in the 2 or 3 or 4 sectors that are in uptrends that are doing better than the other sectors. Go crazy with the last 15%. Buy GBTC with it. By the way, where Socrates was talking about not being able to buy anything because there was nothing available, GBTC was available, but it was very confused back in 2017. I figured it out, but it took me a long time to do it. And now more and more people are seeing the value of that very flawed ETF type of a investment. But boy, believe me, it is not flawed inside an IRA. If you just can figure out the premium discount on GBTC thing, and it's not that tough to figure out, buy it when it's down at 10% and sell it when it's over 40%, some of it, sell the rest of it when it's over 70%, just keep doing it. Repeat and rinse, repeat and rinse, repeat and rinse. Doesn't matter where the price of Bitcoin is going. This thing will work over and over again. I was lucky enough to be able to do that with GBTC from August to December of 2017 and tripled to quadrupled the 4 or 5 different accounts that we were doing that in with all of the money. I said, you would never put all of the money in, just put 15% in of this technique, 60% into broad indexes, 25% into sectors, and go crazy with the other 15%. Well, I went crazy with 100% because I've got confidence in what I do and how I do it in my techniques. I'm not recommending that to you. Just try this other thing. If it starts working well after the first year, 2 years, 3 years, 5 years, and you're doing it on your own, just by running these 3 little moving averages, when they're all up and the price is above them on a long-term basis, you want to be in it. And as they begin to roll over, you slowly get out of it. And if they keep going over, you're completely out of it. Now, that is my view of the best way of doing this for the next 10, 20, 30, 40 years, depending on how old you are. And the word best there doesn't mean ending up with the most amount of money. It means being able to fulfill what the goal was when you started this webinar. A foolproof way to take nothing, if you have nothing, like 85% of Americans, and be a millionaire at the end of this process. That's what the goal is. The goal isn't to end up with 10 million. I've got plenty of clients who've got 5 million and 10 million and 20 million and 30 million, and many of those same clients that lost 30 million and 25 million and 10 million and 5 million and 1 million on the way down in cryptocurrency. And many of them that are now saying, okay, there's got to be a better way. And what Lucid's trying to teach you is the better way. The better way is to understand the difference between investing and position trading and speculating and swing trading. They all fall under this thing called investing, but only one of them is truly investing, and that's long-term investing using all the principles we talk about. Retirement, by definition, is long-term investing. So why mess with that simplicity? You can do it, but be sure you've got the time and the expertise if you're going to play around with more than that 15%. You can blow that 15%, and it should only take you 2 years to get it back. And next time, don't be so aggressive. You're not going to blow the 60%, and you're not going to blow the 25% if you follow the simple rules of long-term investing and how we have taught you to do it. And we are going to spend 3 hours teaching you in detail in 2 weeks from now when we go into Consensio, Intermediate, and Advanced. It is that powerful a tool, in my opinion, and people say, yeah, it's your opinion because you're the one that uncovered them, and I don't believe that's correct. I think I am very careful on saying what I think are techniques that work. Sequential is right there at the top. RSI is right there at the top. Copic curve is right there at the top. But that doesn't mean that some of these other things can't be easily used and understood by you to save you a lot of time and a whole lot of money. And with that, what I would like to do is take a look at some questions for Socrates. Socrates, anything about that diatribe that you just heard?
No, just very, very important information that you are giving us the tools to marry the what you're teaching us with Consensio in terms of using long-term moving averages to determine trends and to get in and out of assets while they're trending in your favor, and to be able to capitalize on profit before they fully reverse. Well, most people are very hesitant to do that, and the main thing in their back of their mind is the tax consequences. In 2017, as price was running up, all anybody wanted to talk about was taxes. And oh my gosh, now I'm going to have to pay so much taxes. And it's just drives me crazy in the sense that if you're paying taxes, that's a good thing. That means you're winning money and the price is going up, and you should not be talking about being upset about having to pay taxes. Did anybody talk about being upset about taxes in 2018? No, nobody was talking about taxes in 2018 because nobody was making any money. So you want to be the person that is not stuck in that sort of circle of, now I'm up money, but I'm not going to take profit because of taxes. And now, oh shoot, now I'm down a bunch of money, but at least I don't have to pay taxes. That is very much an illogical approach and an illogical way to try to make money from these markets in a long-term basis. So Tyler is now giving us the tools of Consensio that allow us to identify a trend in real time in any market, even when, say, an example in Bitcoin, when Hyperwave is telling us that it should continue going down, Tyler has Consensio as a backup plan to make sure that he is not getting totally left behind, and that is how he is able to identify trends and start building positions into assets that are moving in his favor. Then when Consensio starts reversing, he's getting fully out, fully capitalizing on that profit. And in some situations, he's not having to pay any of those taxes, at least not today or this year or 5 years from now. So imagine now we're really helping you to understand how smart money does it. Smart money isn't complaining about paying taxes in 2017 as Bitcoin is skyrocketing. No, the smart money is putting money into GBTC in a retirement account and knowing how to take advantage of that premium, and then also being able to capitalize on that profit in his retirement account without having to pay all sorts of taxes. So that is absolutely having your cake and eating it too. And it's something that may seem kind of simple, like setting up a retirement account. Sure, anybody can go to Google and search, how do I set up an IRA? Simple, it's easy. But that's not what we're doing today. We're not just telling you what Google is. We are more reiterating how vital the benefits are once you get a retirement account set up, and then also what can be done after that retirement account has been set up. And think about what our incentives are and what the incentives would be any other time that you talk to a financial advisor. And this is something that I had a lot of trouble with, is trying to shake somebody and tell them, you need a retirement account. You need to max out your retirement account, and you needed to do it yesterday. When I'm telling them that, and I'm a commissioned salesman, I'm literally, my pay is dependent upon how many of these retirement accounts I can open, and also how much they are contributing. If I get somebody to contribute $1,000 a month, that's paying me a lot more than if somebody's contributing $50 a month or $0 a month. So this is an environment where else can you get advice from somebody with as much experience as Tyler about how important it is to establish one of these retirement accounts? And he doesn't have any incentive. Right now, you guys have already paid to attend this. If you go out and open an account tomorrow and contribute $5,000 or contribute 50 or contribute 0, we're not making any money there. We're not incentivized to make you go out and open that retirement account. So we are trying to be a bit of a go-between where hopefully you can start to see how important this is to us, and it's not because we are incentivized by commission in relation to you using an affiliate link to go sign up somewhere or anything like that. No, we're just here to express how important this is and to try to help people to wrap their head around the different pros and cons, and then also to answer some questions. So after adding my 2 cents there, we definitely did get a number of good questions that hopefully we can get through them all. We've got 15 of them here. Did I just hear somebody?
Yeah,
I did.
Leah.
Yeah.
Leah.
All right, I'll jump in and ask some of these questions because I think that both of you guys are going to have good answers, and therefore I can be dictator and see if it goes first or not.
We can't see your video.
I know, yeah, I'm going to stay off. I may be in pajamas or who knows. And everybody in the chat, if you have a specific question to Socrates or specific question to Tyler, just let me know as well. All right, so let's go. I'll go to Tyler first. What is the best way to invest your 403B? Would you recommend a Vanguard Institutional Target Retirement Fund?
Yes, they're great. Let me just quickly explain what they do. We haven't really gotten into this, but this is an essential part of what we wanted everyone to understand. In an IRA, if you set it up that's self-directed, that means you can pretty much buy and sell anything you want to. In a 401k, there are very often given to you the ability to put part of your money into a brokerage account where you can do anything you want, self-directed, as part of your 401k. Very often, you cannot do that. Very often, they give you a list of things that you can purchase and nothing else. And those things usually are mutual funds in almost all cases. Sometimes there are things called target funds, which are just mutual funds. It's just a fancy name for a type of a mutual fund. It's a fancy type of financial planning. It says if you take the age of 100 and take the number 100 and subtract from it your age, that tells you what percentage you should have in equity. And because of that, what all these companies have done is they came out with what they call target funds. So a target fund for the year 2020 basically says you're going to retire in the year 2020. And because of that, you are probably 70 years old. And if you're 70 years old, then you subtract 70 from 100, and that means 30% will be in equity in that target fund. If you had chosen a 2040 target fund, it says you're going to retire in 2040, which means you're now that much younger, and therefore you're going to have more in equity. And all they do is they basically buy indexes, either in the stock market, the bond market, almost none in cash, and they just change that year after year to keep it in line with how old you are. So what you're basically doing is you're just saying whatever the stock market does and the bond market does in a particular proportion to each other, that's what I'm going to do. And that's what almost everything offered in a 401k by a corporation allows you to do. That's, in general, the way all 401ks work. Besides that, some of them give you very specific things you can buy. You can buy small cap stock indexes, mid cap stock indexes, not only the S&P and the Dow. You can buy international indexes. You can buy gold indexes, gold mining shares index. It can get almost as inclusive as a brokerage account, but not very often, because there's somebody that's taking fiduciary responsibility over not your decisions, but their decisions to give you those choices. That gets back to Department of Labor law under ERISA, that those trustees of your 401k plan they are on the hook fiduciarily for making those choices available to you. That's why you don't see any crypto in there. No one is crazy enough to put crypto in any of their 401ks as something that somebody can buy, because it's way too volatile. They'll lose all their money. They can then sue the corporation through their trustees for fiduciary irresponsibility. So,
all right.
Long way of answering that question.
Thank you, Tyler. All right, Socrates, I'm going to throw this one over to you, given your background as an FA. Am I too late to the game if I'm in my late 30s and just now trying to invest in my 401k and have only about $20,000 vested currently?
Yeah, great question. And definitely would not say that you're too late to the game, and I would never tell anybody that they're too late to the game, even if they really are, because there's no benefit in just saying, oh, well, I'm too late to the game, so I'm not going to put anything to the side. Somebody that's 55 years old and has no disposable income and has no predetermined retirement and only has 20,000 set aside, I would kind of consider that as a very scary situation, where if we don't make some big changes very soon, that this is not going to be a sustainable economic situation. Whereas somebody in their 30s or 40s absolutely still has time. There's a number of different ways that you have time to make up for it. You're not going to be in as good of a situation as somebody in their 20s or early 30s, but you still absolutely have enough time. And really, when you're still in your 30s or 40s, there are multiple ways that you can try to catch up a little bit. The two are very basic. One is going to be cutting expenses and spending less money. The other is going to be to try to make more money. Those are generally the two options, which are very basic and straightforward. But when you're at your age, I mean, mid 30s and 40s, you still do have plenty of time to do the more attractive option, which is increasing income. When you're in your 30s and 40s, you should have some very good work experience and should be getting to a point where hopefully you can start to leverage those skills and make some more money, not necessarily having to work more hours, but potentially by leveraging skills that you had earned over the last 10, 15, 20 years. So if you're in that sort of environment, potentially figuring out how to juice your income a little bit, maybe, trying to get competitive offers for your job. Where I've increased my income in the past, when I was just starting my insurance career, was going from one agency to another. After I had some experience at that first agency, that next agency was much more willing to pay me significantly more. So just from my experience, kind of thinking through the idea that when you're still middle or early age, you still have plenty of time to get after it, work hard, and potentially make some more money. And in that situation, now you can catch up on your retirement and put all that additional income towards retirement. And even if you're not needing to make any significant changes like that, looking at potentially just cutting down on living expenses and setting aside as much as you can. Really, what's going to come down for you, whether or not you're too late, is how much can you set aside today. Like if you can only put aside $25 a month for the next 10 years, now you're going to get yourself behind the eight ball. But if you can set aside a significant amount and really start to max out at least, like a Roth, like something around $6,000 a year, and potentially a little more than that. If you're able to really set aside a good amount on a monthly basis at your age, you absolutely have plenty of time to build up a very good-sized retirement account.
Thanks, Socrates. And again, Tyler, Socrates, if there's anything you want to add to each other's questions, absolutely. Tyler, if I'm going to read it straight, if I do have an active 401k, I don't need an additional IRA. Is that correct? And just if I have to roll it over or am self-employed? Question.
Yeah, only if you've got other income. If you've got a 401k and you've maxed it out, then and you have no other income, you can't just set up an IRA. You can, but there will be no benefit unless you've got other income other than the income coming from what is already covered in your 401k. If you've got a second job, you've got a 401k, but you've got a second job that does not offer a 401k, then absolutely you can set up another IRA. Your point about a rollover IRA simply means that you have left the firm that gave you the 401k, and usually they give you the ability to keep that. And then wherever you're going to work, you can set up something else. You simply can't contribute to the first one. So that's would be my answer.
Thanks. And as a follow-up to that, would you recommend paying? Okay. Would you recommend paying to have someone manage your retirement account, or just putting it into a target fund?
Tough question, and I would. It's a tough question because I'm in the business of managing people's retirement funds, and they pay me 1% of their assets to do that. Now, anywhere you go, even in things like Financial Engines or Betterment or 50 other places, you will pay a fee for what they are doing for you. If you simply buy a no-load fund, like a target fund, remember what is the benefit of doing that, which is very low cost, no management fee except within the cost of the fund itself, which will be fairly minimal today. It used to be a lot. But remember, nobody is managing your money. That means if you've picked an aggressive target fund where a lot of money is in equity, and we go through a 1, 2, 3, 4, 5-year bear market, recession, depression, you will lose half of your money or more. No one is managing your money. No one is trying to make decisions for you. That's the difference between an index fund, which over 100 years has returned 10% per year. You can buy an index fund in or out of a retirement account, which is what John Bogle said to do at Vanguard. To me, that is ludicrous. You have worked hard for that money, and major professional organizations are telling you there is no reason to worry about the future. There is no reason to worry about the debt problem. There is no reason to worry how close we came in 2007 and 2008 of total financial collapse, in which case those index funds would have dropped down close to zero, as would the equity portion of your target funds. So the difference between having a manager or managing it yourself using simple techniques that you can pay a small amount of money to learn, and going blindly with buy and hold forever because everything's going to be all right, to me, number one is pick a good manager. Number two is learn it yourself if you've got the time and the proclivities and the inclination. And number three is to fly blind. Get up in the airplane, turn off all the instruments, and put a black blanket over the windshield. Good luck.
Great. Tyler, in previous vlogs, you've mentioned there are particular negative tax consequences when buying short leveraged ETFs in a regular brokerage account. If we wanted to speculate with the 15% in an IRA, do any of these negative consequences affect us by going short in the way?
That's a great question. I know who asked it, and he's a very smart investor. And I've warned him about the problems with 2x or 3x inverse funds. We used them in 2007, 8, and 9 to completely protect our clients' assets using a very simple formula, which is we sold 1/3 of their positions, which was a taxable event unless it was in a retirement account. We took that 1/3 and we put it into a 2x fund that was inverse to the market. Now we've got 1/3 long the market, 2/3 short the market, and net, we had I'm sorry, 2/3 long the market, 1/3 short the market, but was 2x the market. So we were even with the market, which means that if the market went up, we did not lose any money. If the market went down, we did not lose any money. If the market went up, we did not gain any money. And if the market went down, we did not gain any money by using that 2x fund. What we didn't know at the time, because it was pretty early with these 2x and 3x inverse funds, was that they were forced by the IRS themselves to make a distribution at the end of the year, which was a taxable event for clients. That is in taxable accounts, and it was a huge hit that clients had to pay in the form of taxes on those gains. And those have not been completely worked out. But you're asking if they can be bought in a retirement account with the same tax consequences. I don't believe they can be bought in a retirement account. If you've got a retirement account that lets you buy leveraged funds that are inverse, I believe there's something wrong with the structure of that IRA or the 401k, and there's somebody that is fiduciarily making a mistake. So I can't say that for sure because I stopped using 2x and 3x funds in retirement accounts, inverse funds in retirement accounts, since I learned that lesson early on. And I only use 1x funds, which don't have the same problem from a tax point of view, either inverse or regular funds, index funds. So that's kind of long-winded, but that's the best I can do on that one.
Thanks, Tyler. And to Socrates, pretty simple one, but important one. Do you recommend a Roth IRA over traditional?
All right. Yeah, so that is a good question. Definitely one that we don't want to get people too confused with the minutia because, like Tyler said, often, definitely what's most important is getting one of them set up. And the difference between the two is basically a coin flip. If you're looking at paying down taxes now on the Roth, and then when you withdraw, there are no taxes to be paid at all because your contributions were taxed up front and your earnings will not be taxed as long as you're making a qualified withdrawal. That's a Roth, and the traditional is that money is tax deferred up front. So it's put into that account before taxes are taken out. And then when I'm ready to withdraw, the earnings are not taxable, but the contributions are because they were not taxed up front. So in the end, it's pretty much going to be a coin flip. There are some things to consider in terms of the contribution limits are going to be higher for a traditional IRA, and then the Roth IRA will allow for some withdrawals that they're basically qualified withdrawals that are not, that they're before retirement, before the age of retirement has been met, and that is for something like a first-time home purchase or college expense for kids. And really, if you're looking to set aside some money and you're saving some money for a first-time home purchase, putting that into a retirement account doesn't necessarily make a whole lot of sense. But it can be a good idea in a Roth IRA because you can go ahead and take advantage of those tax-free earnings and then make a qualified withdrawal for something like a first-time home purchase or putting kids through school. So there are some details there that you probably will want to try to uncover before opening an account for yourself. And I would suggest you can go online and just do it all yourself and call a customer service number. Or you could sit down and meet with somebody face-to-face, depending on how comfortable you're feeling. If you're really not feeling very confident on either the Roth or the traditional because you have some last questions in your mind, then definitely sit down with a CPA and go over those questions. Today is not really to identify what is best for each individual person. It is more to just say that that if you have one or the other, it's going to be infinitely better than having nothing. And therefore, if you do maybe pick the wrong one, you wouldn't figure that out probably for years down the road, and it's still going to be in your best interest to have one of them as soon as possible.
Thank you. And Tyler, follow up to that one?
No, I think that really covers it very well. 95% of what we're trying to say is just get it set up and max it out. Number two is if you can't max it out, get one set up and put as much as you possibly can put into it, and then try to make that up at a later time. But don't get into the habit of just because you can't max it out now that you don't max it out as soon as you can. As soon as the day comes when you can match your employee contribution, when you can go above that to get up to the max amount you can contribute, that's when you want to do it. You don't want to wait a week or a month or a year, or you're never going to do it. Do it as quickly as you possibly can.
Great. And here's a fun big one. Can you touch on the effect of the economy, the stock market in particular, on your plan being presented? Meaning, if one was to put $18,000 a year into 401k in a up economy trend versus the same amount being invested in a down market trend over the next, say, 1 to 5 years?
Yeah, that's a great question. And that's what everybody should be thinking about every time in a brokerage account or in a retirement account, they're making a decision to take money out of cash and put it into a risky asset. So right now, we are fully invested in the U.S. stock market. Therefore, if you were to set up an IRA today, my recommendation to you would be to be fully invested in the U.S. stock market today. And then to know why you are fully invested. You are fully invested because according to Consensio, the price is above the long-term, the intermediate term, and the short-term moving average, which is all moving up and they're all above each other, period. And if we were having this webinar in 2007, 2008, I would be telling you, you want to set up your IRA, you want to put as much money as you can put in it, and you should keep it all in cash. And why would I say that? I would say that because the price was below the long-term moving average, which was below the intermediate, which was below the short. The price was below the short, which was below the intermediate, which was below the long, and they were all moving down. And therefore, you should have no money in that thing. What is that thing? Yeah, it is the U.S. economy, but more importantly, you don't buy the U.S. economy. You buy a security. You can buy an index that reflects the U.S. economy, like the S&P 500. But what you're really doing is you can measure very specifically each of the indexes that are traded like the S&P 500. So your answer is, if you did it today, you want to be 100% in the S&P. I also said the diamonds, the Russell 2000, and mid-cap stocks, as well as the NASDAQ in various amounts, but adding up to 100%. That's where your retirement account should be. And you should be able to do that calculation in 3 minutes. And that's all you need to know. Now, what will happen is that calculation will change between a bull and a bear market. And you need to understand what happens, as opposed to saying, if you're in a bear market, what do you do? And if you're in a bull market, that's not going to be a problem. That's easy stuff. The problem is, are you in a bull market or a bear market? And over time, that will change. Going back into history, that changes. Going into the future, after you've set up your account, that's going to change. And that's the simple way. You don't have to pay a manager. All you have to do is follow that very simple system, and you will be in at the right time and on at the right time.
Fabulous. And we have one last question. Big one. Can you discuss your thoughts on risks related to underfunded pensions and or bank failure? I just got a pension supplement form that explained, due to a change in law, how employer minimum requirement contributions are calculated. And there's a quote: employers may contribute less money to the plan at a time when market interest rates are at near historic lows, end quote.
Yeah, that's just a quick anecdote. I almost left my job at the bank managing money for the trust department and for Amidus Capital Management and everything else because I became so absorbed with this problem of underfunded pensions. There was a guy that had set up a company that would help corporations go from underfunded to fully funded. And he wanted me to join and help him do technical work. And to me, it was so important at the time, I almost did it. All of the big institutional money I managed became underfunded over the years. Almost all corporate and institutional money, pension funds, almost all state, municipal, and government pension funds are grossly, grossly underfunded. What they're promising to pay you, they can't pay you. So they play all kinds of games. But they can't play games with pension funds under ERISA. There's very specific rules that say how much funding needs to be there for a corporate pension fund over various time periods. And there's huge committees set up every year that hire CPAs and hire actuaries and hire lawyers and hire tax consultants and hire money managers to go through all of those numbers to make sure they don't become underfunded. And all underfunded means is actuarially for the next 20 years, if you've got 10,000 employees, you know how old they are, you know how long they work for your firm, therefore you can predict when they are going to retire. How much money do you have to have today to make sure that they can retire in 20 years? Now, there's all kinds of calculations that go into that, but simply you make an assumption about your investment returns. You make an assumption about interest rates in the United States. And from those assumptions, you do a calculation which says, here is full funding for us today. If you're wrong on your assumptions, you might very well be grossly underfunded already. So there are people that check your assumptions to make sure that they're in line with everybody else's assumptions. And if you fall somewhere in the middle of everybody else's assumptions, they let it fly. But everybody else's assumptions after the 20-year bull market from 1980 to 2000 kept creeping up and up and up, where the returns on investment in the stock market and the return on investment in the bond market was so strong that everybody wanted to use those numbers as their future predictions. And when you do that, that means that the companies don't have to fund their portfolio or their pension fund that year as much as they would have if they didn't have such high expectations of returns. So as soon as we started 2000, we went into the dot-com bubble in a 3-year recession, followed by the 2006, 7, and 8 recession and stock market bubble that lost so much of pension money. Why? Because pension money managers couldn't get out of the market. That funds, and I'm talking about California and Harvard and municipalities, anyone that has ERISA pension funds are restricted from doing certain things. So they wrote it all down, wiping out their pensions. And the only way they can get it back is for a prolonged bull market to get rates of return back far above what they were for the 10 years where they were zero. And everybody was assuming they were going to be 7%. And when you take the difference between a 7% assumption of returns and zero, and then actuarially run it out for the next 23, 30 years, you are in trouble. And what it means is you can't pay the people that you have to pay. And what that means is you don't get a bonus for realizing that. You get penalized by the Department of Labor a huge penalty for being underfunded this year. So now not only are you underfunded, but you have to take money out of corporate profits to pay the penalty for being underfunded. And it just keeps getting worse and worse after that. And it's as bad as it's ever been as we sit here today. This is true all over the world, not in the United States.
Thanks, Tyler. So I think that's the end there. So if you can, what are the biggest takeaways that we should, everybody listening and people who, listen to this in the future should absolutely take away from the past 3 hours?
Well, I'll give you my shot, and then I want to definitely hear what Socrates says, and I'd love to hear what you say, Leah, too. But number one is do it today. If you're already doing it, congratulations. You're one of a very, very few. And you know what the do it means. I've said it 1,000 times today. Number two is we've tried to teach you things over the past year and a half that show you that in a retirement account or a non-retirement account, there is an intelligent way about going about investing. Apply it to both. But certainly apply it to the retirement account in terms of being very flexible in what your decisions are, what you want to do, and how you want to do it, because you don't have to worry about tax consequences. That gives you a lot more flexibility than you do if you're just trading a brokerage firm account. I know that because as a manager, I can treat retirement accounts much differently than I do brokerage accounts because of the tax. I have to think about selling a position for a profit in a taxable account. I don't have to do that in the retirement account. And yes, sometimes that means I don't make a call that I later regret having made because of this silly way things are taxed. Number three is if you don't feel confident in what I just said about number one and number two about applying Consensio, my third takeaway is please sign up for our Consensio intermediate and advanced webinar, which will be 2 weeks from now. We will go in depth on what you need to know to apply Consensio to your brokerage accounts as well as your retirement accounts.
Thank you, Tyler. Socrates, hot take?
All right. First of all, just a great point there by Tyler that the calls that he makes and the decisions that he makes will sometimes be dependent on what type of account the money is in. And imagine sitting on a whole bunch of unrealized profit and letting that slip through your fingers because the taxes that you were going to be paying caused you not to go ahead and take that profit. And then now instead of having some profit and then a little tax liability, now you just let that entirely slip through your fingers. That can absolutely happen sometimes, can and will. And the way that you can protect yourself the best is to make sure that you are protecting yourself from taxes in a ERISA retirement account, which will allow you to take profit and not have those profits taxed. And that is what Lucid is all about, is capitalizing on that profit before the markets fully reverse. Almost nowhere in the world no advisors in the world will tell you that it's time to sell, that we are entering a bear market. And Tyler is one of the only people out there that will put his neck out on the line and say that, yep, we are getting fully out of securities. This is entering a bear market. I want nothing to do with it unless I get buy signals to enter back into. So when that's the approach that's being employed, it is vital to have a retirement account set up. You just think about if you're taking all of Tyler's advice and you're not using a retirement account, you would end up doing significantly worse, could even end up potentially a net loser if Tyler doesn't know you, doesn't know who you are, and he's making recommendations based on his situation, and you're not even aware how much different your tax situation is because you do not have a retirement account. That can change a huge winner into a small or even a very significant loser. So definitely having that option, having that availability to get out when sometimes you're not even wanting to take profit. Sometimes you're just scared about losing. Like if you're entering right now, say right now you're buying the S&P, Consensio recently turned bullish and we recently made a new all-time high. I recently bought. There's a lot of reasons why you might want to be buying the S&P right now. Well, what if something happens next week or just over the weekend, Trump sends out a tweet and now you're like, holy crap, I do not want to be in this market. And now you can go ahead and get all the way out and maybe at like basically break even or so and not have to worry about any sort of capital gains that may or may not have occurred in there. So this isn't just for taking profit, but also for protecting yourself when it looks like the markets may be turning against you and you're not yet in that profit. So today what we covered was just, first of all, just open it. Don't worry about if it's a traditional or a Roth or a 401k. Don't get too bogged down by that minutia. Just first thing you want to do is open it. That's it. Second thing is what to do once you have it opened. Well, you need to fund it. And from there, you need to have a very, very, very specific game plan. And that game plan is going to be determined based on your specific skill set, your time horizon, your risk tolerance, and basically what you're trying to achieve. Some people will absolutely be best by having somebody else manage their money. If you are all day, every day, you're working full time, you've got a family, you've got kids, to manage your own retirement account, that could be a whole nother basically part to full-time job. You don't want anything to do with that. So you want to pay somebody 1% to manage your account. Absolutely, that is going to be the best for some people. Once you have it open and you're trying to figure out what to do with it, it's going to be based on your skill set and what you're trying to accomplish and how much time you have available to accomplish those goals. If you are one of those people who is all day, every day, has their nose in the markets, and you really, really enjoy this stuff, you really want to take control of your own finances, you want to make sure that I'm not in necessarily a target fund where I can get out, that I'm going to be able to have control of my money. If you're that type of person, then you can manage your retirement account as if it was a trading account on BitMEX, essentially. I mean, you're not going to be able to use leverage or short, but you can now set up this retirement account and use your skills to implement the TD sequential or Consensio or whatever the case may be that you have found successful to grow your account at a tax-free basis where the earnings are not going to get taxed. That right there is, if you can do that, get yourself in a tax-deferred, tax-protected environment and then consistently contribute to it. If you do that, then the time and money that you spent today will be worth it tenfold, and it won't take very long for you to realize that. So I really appreciate everybody for attending. I appreciate the kind words and comments that we're getting in the chat, and certainly appreciate everything that Tyler has shared with us, and appreciate Leah for logging on and asking us some questions.
All right, that was fantastic. Thank you so much, Socrates. Thank you so much, Tyler, and everybody who attended.
Thank you all. Thank you, Leah. Thank you, Socrates.
Thank you.